Have you ever wondered how the major indexes like S&P 500, Nasdaq, and Dow reached their record highs recently? You know, it's not every day that you see all three of these financial giants hitting such astounding numbers. And it's all thanks to some encouraging data about inflation cooling off. But what does that all mean? What's the story behind these record-breaking numbers, and what role did inflation play in all of this? Well, let's unravel this financial mystery. On a fine Wednesday, all three major indexes surged to record highs. The S&P 500, the tech-heavy Nasdaq Composite, and the blue-chip Dow Jones Industrial Average all closed at new peaks. What sparked this climb? Fresh data revealing that inflation cooled down in April. Let's dissect these figures. The latest consumer price index showed that prices have risen by 3.4% over the 12 months ending in April. This was a slight ease from the 3.5% increase we saw in March. Following this news, the broad market S&P 500 gained more than 1.2% on that Wednesday, cracking the 5,300 level for the first time, and closing at 5,308.15. The Nasdaq, on the other hand, was about 1.4% higher, setting a new record at 16,742.39. And the Dow? It was up 350 points or 0.9%, teetering near the key 40,000 level, and closing at 39,908. This record-breaking performance wasn't just a one-day wonder. All three major indexes are tracking toward a winning week. Now, you might wonder, what's the reason behind this optimism? Investors believe that the cooler inflation reading, coupled with a separate report showing weak retail sales in April, increases the likelihood that the Federal Reserve will cut interest rates this year. Gary Tseggio, head of fixed income at CIBC Private Wealth US, summed it up nicely in a note to clients that Wednesday, stating, "Taken together with retail sales, this supports a Fed rate cut in the fall. So, the markets are discounting a rate cut in September and have moved to price in a second cut by December." And this, ladies and gentlemen, is the story of how the indexes reached their record highs. A winning week indeed, for all three major indexes. So, what led to this impressive surge, you might ask? Well, the answer lies in the interplay of a couple of key economic indicators, inflation and retail sales data. You see, recent data showed a cooler inflation reading. The Consumer Price Index, which gauges the average change over time in the prices paid by consumers for a market basket of consumer goods and services, showed prices were up 3.4% for the 12 months ended in April, a slight easing from 3.5% the month before. Now, why does this matter? Because inflation is like the temperature of the economy. Too hot and it can scorch growth, causing prices to soar and purchasing power to plummet. But too cold and it can freeze economic activity, leading to stagnant wages and a sluggish job market. So, a cooler inflation reading is like a Goldilocks scenario. Not too hot, not too cold, but just right for steady, sustainable growth. But that's not all. A separate report showed weak retail sales in April. Now, you might think, isn't that a bad thing? Normally, yes. But in this context, it actually works in favor of investors. Here's why. Weak retail sales signal to the Federal Reserve that the economy might need a little boost. And one of the ways they can do that is by cutting interest rates. Interest rate cuts stimulate economic activity by making it cheaper for businesses to borrow money, which they can then invest in growing their operations. And for investors, lower interest rates can lead to higher stock prices as companies' profits increase. So the combination of cooler inflation and weak retail sales increases the likelihood of a Fed rate cut. And investors, always keeping an eye on the horizon, are betting on this possibility. As Gary Tseggio, head of fixed income at CIBC Private Wealth US, notes, markets are discounting a cut in September and have moved to a price in a second cut by December. It seems like a Fed rate cut in the fall is on the horizon. And if this prediction holds true, we could see the markets continue their upward trajectory. Now, let's talk numbers. The Consumer Price Index, or CPI, is a measure that examines the weighted average of prices of a basket of consumer goods and services. This basket can include items such as transportation, food, and medical care. The CPI is calculated by taking price changes for each item in the basket and averaging them. The goods are weighted according to their importance. Now, on to the report. The CPI report for April landed mostly in line with economists' expectations. Economists had predicted a monthly increase of 0.4% and an annual gain of 3.4%. The actual numbers, they were on the nose. On a monthly basis, prices rose by 0.3%, a slightly slower pace of growth than the 0.4% seen in the 2 months prior. This was a welcome turnabout from January, February, and March, when CPI and other inflation gauges came in hot. It seemed like the inflation environment was stagnant, but this report suggests otherwise. For the 12 months ended in April, prices were up 3.4%, easing from 3.5% the month before. This indicates a cooling inflation reading, which investors believe increases the likelihood of the Federal Reserve cutting interest rates this year. Rising gasoline and shelter costs accounted for more than 70% of the monthly increase in overall inflation. On the other hand, grocery prices fell for the first time in a year, dropping 0.2% from March. A closely watched underlying measurement of inflation, core CPI, which strips out the more volatile categories of energy and food, slowed from 3.8% to 3.6%, its lowest rate since April 2021. So, what does this all mean? It's a reminder that inflation is a complex beast, influenced by a multitude of factors. It's not just about the cost of goods going up, but also about how these costs compare to wages, interest rates, and economic growth. It's all about the numbers, isn't it? But what about the rising costs? That's the big question on everyone's mind. As the markets surge, it's crucial to remember that this exciting news comes with a caveat: the rising costs of certain essentials. Let's talk about gasoline and shelter first. These two elements have played a significant role in driving up inflation. In fact, they accounted for more than 70% of the monthly increase in overall inflation. Yes, you heard that right, over 70%. This is a significant chunk of the inflation surge that we've been seeing. Gasoline, as we all know, is a crucial commodity. It powers our vehicles and indirectly it powers our lives. When costs at the pump rise, it's felt across the economy. Similarly, shelter is a basic human need. As housing costs climb, it puts a strain on the wallets of millions of people. It's the kind of expense that you can't escape, no matter how tight your budget might be. But it's not all doom and gloom. Amid the rising costs, we've seen a ray of light in the form of dropping grocery prices. This is the first time in a year that grocery prices have fallen, providing some relief to households. It's a small but significant development that reminds us that inflation isn't a uniform process. Some costs rise and others fall. The drop in grocery prices, however marginal, is a welcome respite. It's a reminder that while the cost of certain things like gasoline and shelter can skyrocket, other areas of our lives can offer us a breather. In this case, it's the food in our kitchens and on our dining tables. So while the markets may be hitting record highs, it's important to remember the bigger picture. On one hand, we have the rising costs of gasoline and shelter, driving up inflation and putting pressure on household budgets. On the other hand, we have the falling grocery prices, offering a glimmer of hope and a sigh of relief. So while some costs rise, others give us a breather. It's a complex dance of numbers, but one that we all partake in as we navigate the economic waves of our times. So, what does all this mean for you? Let's break it down. The S&P 500, Nasdaq, and Dow all achieved record highs due to encouraging inflation data. This surge was largely influenced by the Consumer Price Index, which showed an easing inflation rate of 3.4% for the 12 months ended in April. This is significant. Why? Because the cooling inflation, coupled with weak retail sales in April, increases the chances of the Federal Reserve cutting interest rates this year. And lower interest rates can stimulate economic growth, making it cheaper for businesses and individuals to borrow, spend, and invest. But it's not all roses. Rising costs, particularly in housing and gasoline, accounted for over 70% of the overall inflation increase. And while grocery prices have fallen for the first time in a year, the cost of owning and maintaining a vehicle continues to rise, with motor vehicle insurance climbing 1.8% in April. In essence, these developments present a mixed bag for investors and the general public. On one hand, the potential for lower interest rates could lead to increased economic activity. On the other, rising costs in essential areas continue to place pressure on household budgets. Keep an eye on these indexes, folks. They tell a story that affects us all.